So what's happening right now is companies just aren't ordering. They're simply on hold. And so the longer that we have these tariffs, and the reason they're not ordering is because they don't have the margins in it. And I think this is a big thing that consumers need to get their head around is the vast majority of products, you look at Shein and Temu and they're like, oh, this thing has 500% markup. And that is absolutely the case with certain types of products. But when you get into certain other SKUs, the majority of products are lower margin. They may have 30 or 40% gross margins in it. They simply cannot afford 145%. And so putting that on hold entirely means that our new order is going into China.
Hi, I'm Steve Eisman, and welcome to my podcast, the Eisman Playbook. In my 35 years of experience of investing in markets, I've seen many ups and downs. You might know me because I was depicted in the book The Big Short by Michael Lewis and portrayed by Steve Carell in the movie of the same name. In this podcast, we are going to explore and analyze market trends, companies, and subsectors with various guests in and around the financial world. My goal here is simple, to educate. So come and join me as I share with you the Eisman Playbook. Hi, it's Steve Eisman, and welcome to another episode of the Eisman Playbook. It's April 30th, 2025. The market has just closed, another tumultuous, volatile day, which seems to be the norm these days. Before I introduce my guests, let me just say that, it's earnings week. The number of companies that are reported could make you dizzy, but I would say this has not been a good earnings season so far. You haven't seen really companies miss, but a lot of companies have pulled guidance. Some companies like General Motors have announced that they will no longer be buying back stock for the time being. Everybody's mentioning economic uncertainty, tariffs, et cetera. But it has not affected the market very much, at least this week. The market's pretty much flat. I don't know what's going to happen. As we're speaking, some of the biggest companies are about to report, so I'm not going to make any predictions. But things are starting to happen. And to help us explore what exactly that last sentence means, I'm very pleased to say, Craig Fuller, who is CEO of FreightWaves. Craig is the FreightWaves is a freight-focused organization that delivers a complete and comprehensive view. I'm reading, Craig, from your thing, of freight and logistics markets. Prior to that, Craig was the founder and CEO of Transcard, a fleet payment processor that was sold to US Bank. And he's also a trucking industry veteran. So the obvious question somebody might ask is, what's a guy like Steve Eisman, who specializes in banks, talking to a logistics guy? And let me explain why that you're here. So there's this wonderful show on Amazon Prime called Reacher. And I'd recommend it to anybody. But the character, who is a former military policeman, has this line that he repeats just about once or twice every single episode, which is that in any investigation, the details matter. And one thing I learned from a guest a couple of weeks ago, who is an expert on Germany, we learned how complicated the negotiating would be with Germany because of the EU and each individual country. So there's an example of the details matter. So Craig, welcome to the Eisman Playbook.
Steve, happy to be here. By the way, I'm a big fan of Reacher. My wife and I watch it quite often.
An amazing show.
It's great. It's great. I remember the first episode we were watching. It's kind of like it's one of these shows that sort of builds and momentum over time. It's like Yellowstone. You kind of get into it. So I recommend watching.
I watched that show too.
Once you watch them, you're hooked. You got to know what's going on. Yeah.
So Craig, the reason why you're on is I follow you on X. I've seen you on TV. A lot of people get on television and they just like to pontificate about trade and their opinions about trade. But you're a logistics guy. You actually have some knowledge about what the hell is actually going on right now on the ground. So I have a bunch of questions, but I thought we would just start with kind of an overview of, we're not going to get into, Is President Trump right? Is he wrong? We in the markets, we take the pitch that's given us. We're not making any kind of political predictions here. So let me just ask, that's my dryer. So hold on one second.
Steve, I'm glad it's you this time. I this notification thing is like, it's a phantom, the app that keeps showing up.
Noise.
And I haven't been able to turn my computer off to reboot it.
That's okay. Don't worry about it. So the reason why you're here is, let's talk about, logistics. There's, as far as I can tell, there are basically three parts of logistics. There's container shipping from overseas. There's intermodal, which is trains and trucks. And then there's trucks, which always bring things to the last station. So if you could just give us an overview of the whole logistics world right now. What are you hearing? What are you thinking?
I would argue that logistics is actually far more nuanced. There's a lot more than just three modes of traffic. We haven't included air freight in that. We haven't talked about barges, but essentially logistics is the act or the process of moving a product from point A to point B. It started out with walking as we were out in the prairie and has ended up in the sophistication of these modern supply chains. And I think the reason that I'm relevant, because they only bring me out, the only time I end up
they only bring you out when times are bad.
But yeah, I only am brought out to deliver bad news. And sometimes I get lampooned on late night comedy TV for being the alarmist. And I promise you that's not my normal MO. But the reason that this is such an important topic for financial markets is that we are in this really interesting time in history where we are moving into a new era of the post-globalization era, and people just don't understand it. And the reason that logistics is so relevant to the story is because if you want to understand the intersection of the Main Street economy and how products are moved to all of this sort of backdrop of geopolitical elements and financial elements, logistics and supply chain is the source of truth in that. And so what we do at FreightWaves is we track global markets. We're often called the Bloomberg of freight because what Bloomberg does in the physical or in the financial economy, we aspire to do in the physical goods economy, which is we have a set of 50 journalists around the world that are basically writing original context and getting stories and then looking at data to get the ground truth, high frequency data of all of the products that move. So that's container shipping. That's rail, which you said is intermodal. That's the containers that are put on trains. That's trucking. That's air freight. That's all the modes of traffic, and even include things like warehousing and local delivery, and all of this stuff really keeps our economy moving. And for most people, this is a really boring topic. And most of the time, I got to admit, unless you love it, it's not that interesting.
So what are you hearing these days? Because you are very relevant.
Absolute chaos. And so what's happened is that, and this has been building for a couple of years, and I think it's important to note that ultimately what we're seeing with China and the United States, and let's just be very clear, from where I sit, this is entirely a US-China story. Yes.
So let me pause you right there for a second.
Okay.
Why do you think it's mostly a US-China story when we're talking about tariffs on China, on Canada, tariffs on Mexico, tariffs on Europe? Elaborate on that. I have not heard that.
Yeah. So the reality is that so much of what China did in the first administration. So if you sort of back up to where sort of talk about where this all started, really it was in Donald Trump's first administration is when we had the first trade war. It was at that point, it felt like a massive disruption to put these tariffs on China. And, he came into office and said the Chinese are ripping us off. They're a security threat. We need to address this. And so he ended up implementing these tariffs. But what the Chinese did, being some of the smartest, most entrepreneurial people in the world, is they actually moved some of their production and even would move some of their exports through other markets. So they would open up a warehouse in Vietnam and essentially take those products that were meant for the United States and repackage them up as products that look like they were coming from Vietnam. And so they were doing something.
So they did an end around.
Indirect. So transshipping is a term, border skipping is a term that we would use. And essentially what the Trump administration has identified correctly is that by having tariffs on just China, you're not actually impacting the Chinese economy. And the reason that this is a China story is you have two very powerful, I mean, the only players in the global economy that really, really matter in terms of geopolitics is the United States and China. Yes, Europe is there, and I know you probably have European listeners, and they're probably really upset, but they're sort of an actor that is in many ways sort of behind the scenes, if you will. Like Europe is, when we're talking about what's happening right now, it is United States and China. It's all about that. And so what the Trump administration is trying to do is really stranglehold the Chinese economy, and it has to effectively make it expensive and cut off trade from other countries that that essentially Chinese manufacturers and producers are zone skipping or transshipping from China through their country to the United States. And this has been happening. It's pervasive. Everybody in logistics knows it. And it's something that the Trump administration wants to get a hold of. So that's why we have part of the reason we have global tariffs. I mean, fundamentally, the Trump administration has an argument about trade broadly, but that's the reason they're picking on these very irrelevant countries in terms of our trade. And it feels
like you're talking about like Vietnam, Cambodia.
Well, Vietnam's not irrelevant. Vietnam's incredibly relevant as a trading partner.
So when you said they're picking on countries that are not relevant, what do you mean?
Yeah, like Laos.
Laos. So Laos is China's a form of end run around.
That's an example of that is an example of an end run round, but it's also an irrelevant and global trade. The Maldives is an irrelevant country, but it's still, they added tariffs on the Maldives. Or my favorite one, I think it's Williams Island or something, that's like the penguins, and it's sort of like this memes where there's absolutely zero humans there, and they put 10% tariffs. And so this is effectively what's happening is the Trump administration is trying to squeeze China as much as possible to squeeze the rest of the world. And part of what I think they're trying to do is send a loud and clear message to other countries that if they continue to allow their borders to be used to transship product through their country, then the U.S. will be incredibly punitive to them in return. So if Vietnam doesn't slow their imports from China, then transship them to the United States, then, in lack of a better term, the Trump administration Vietnam will have hell to pay. And I think that's what we're seeing. Is it seems quite bizarre that we have these tariffs on the entire world. But a lot of it has to do with this geopolitical framework of an inevitability. And even when Biden was in office, we were talking about the second Cold War. Make no mistake, that's exactly what we're in. We are in the second Cold War, and supply chains are the front lines. So what you're seeing happening geopolitically is we're seeing all these things take place, when we had global free trade and there was one superpower and the United States was the world's policeman, it had no interest in disrupting that order because there was no threat to U.S. global supremacy. But now that China has ascended and has frankly been the biggest beneficiary of U.S. hegemon, of the United States playing the world's policeman, China has immensely benefited from that. There is this rivalry.
What do you mean by China has benefited immensely from the U.S. being the world's policeman?
Just think about China is the world's manufacturing center for some reason. And the reason is that they have been able to take the arbitrage of cheap costs of producing goods because of cheap labor, no human rights rules, no environmental laws, or very limited environmental laws. And so they've been able to produce products that are far cheaper than, frankly, the rest of the world, or most of the modern sort of developed world. The only reason that they've been able to build this manufacturing and supply chain center and sort of center of the universe is because the United States has been playing the world's policeman. That the Chinese have actually benefited greatly because the U.S. Navy is protecting all these trade lanes around the world. I mean, pirating. I mean, think about the Strait of Malacca. So you're talking right outside of Singapore. That is one of historically has been prone to pirating.
But not anymore.
But not anymore because the U.S. Navy is protecting those trade lanes. And the U.S. Navy's position is basically eliminating all the, not eliminating.
Okay, so I understand your point. So you're basically saying, despite all the news about Europe and Canada and Mexico, you think this is mostly, not completely, but mostly a US-China story.
Yeah, that's exactly right.
So let's turn to what are the facts on the ground?
So
what's actually happening in logistics right now?
Yeah, so we've seen a 65% drop in container volumes.
Say that again. I want to hear that number again.
We've seen a 65% We've seen a 65% drop in container bookings out of China. So this
out
is
of China, from out of China into the U.S.
That's correct.
Okay.
And so
bookings.
What that means is that the volume of containers that we had prior to the Liberation Day tariffs going into effect and the escalation of those tariffs,
right?
If you sort of looked at prior to that time to where we're at today, we've seen a 65% drop of container volumes out of China to the U.S. So that's the first thing. Year over year, we're off about 35%. Like if you look at
bookings or shipments.
Well, this is volume of containers. So think of it not in terms of the total shipments; it's the total number of containers, which are, in most times, they're kind of one for one, or at least I shouldn't say one for one, but the number of shipments per container does fluctuate, but it tends to be pretty measured. In these extreme periods, you actually see that correlation break, and it's because the bigger companies are ordering a lot more product. And effectively what's happened is companies have said to their manufacturers in China, hey, I ordered these products. It's great that you manufactured them, but I'm not taking delivery. I'm not taking 145% tariff on my product. Put it on hold. And so these manufacturers in China have gone out and built these products and manufactured them on behalf of American businesses. Oftentimes, they've extended credit because they have these trade partners that they've done with business many years. The Chinese manufacturers have extended credit to American importers. So think like Walmart isn't paying for the product when it puts the order in; it's paying for the product when it's delivered, as an example.
Okay.
And so if you're, or Nike in this case, or Apple, or just
I see. So the manufacturer in China is actually paying for the production without any money, expecting to be paid once this thing is delivered to Walmart.
For the largest companies.
Larger companies.
For some of the smaller ones, they may have a deposit. If it's a new relationship, they may require 50% up front. So there's all these sort of trade relationships. But if you're doing business with a company like Walmart, that's a great credit, you've been doing it for many years, you're going to just extend them credit, and you want payment upon delivery or payment upon terms. And it's a normal trade relationship. That's how trade is done. And so what's happening is when the tariffs hit at 145%, those American companies contacted their manufacturers. So the people that are importing these products contacted the manufacturers and said, I don't want to take delivery of these products. I want you to pause delivery. So think about the cash flow from a Chinese manufacturing company is all of a sudden the products that they've gone out and built are on pause and they're piling up at the factory. Meanwhile, so some freight still flowing out. We haven't lost 100%, 35% before the tariff went into effect. That freight's still flowing. And that's where that 65% drop is. The 35% is what's flowing, sort of where.
So 65% bookings are down, 35% less flowing.
Yeah, 65% bookings, 35% that base volume is. There are still shipments coming from China. We have not.
Right. It's not zero.
We still have freight coming from China, but if you look at it on a year-over-year basis, it's down 35%.
Okay.
So what's happening is that. So that's the first part of it, and that's what's we're seeing on the ground. We have about a 3-week lead from the time that stuff's booked to the time it's supposed to hit the U.S. ports. The Liberation Day tariffs went into effect on April 9th. That's when they were effective. And so now this week, we are in sort of the first fallout of volume. So what would have been in the Port of LA and the Port of Long Beach, the volume is off by.
So just to go back, it takes 3 weeks to get something from China to California.
Right. Yep.
Okay.
Yep. 2 weeks, but typically you'd like to think of 3 weeks because you have the whole booking process of loading it in the container, trucking it, and getting it onto the ship. And it may sit on the shipyard for 2 days before it gets loaded. So there's a whole process that takes place. And I think people oftentimes misunderstand the timelines in supply chains. American consumers are so used to, and I don't know how old you are, but when I was growing up watching Saturday morning cartoons, you would watch
I was old enough to watch those.
and so you would see the commercials as a kid, and it would say, take 6 to 8 weeks for delivery, right? And this is
Right.
because it would go. That was the world that used to be, and frankly, compared to what we're talking about, is quite fast. Even at 3 weeks from China, this stuff was in an American factory or American warehouse. It took 6 to 8 weeks, and now what we're talking about is going from China there. But what people oftentimes misunderstand is that when they order product, the product has probably been produced 6 months to a year before they've ordered it. They're not getting real-time manufactured products. Most products have these long lead cycles up to a year. And so we've talked about the delivery cycle of produced products. So let's talk about another thing that's also happening, which I think is perhaps more concerning, is that companies who have suppliers in China are not ordering anything new. And these
Correct.
lead times are about anywhere from 6 months to a year out. So,
so in other words, like if you're ordering toys for next Christmas,
for this Christmas,
you might order them now, and you
likely would.
Them.
So you're probably on a 6-month lead cycle, and so you go to your contract manufacturer. Let's say we're doing model railroads as an example, and
I read your article about model railroads.
Yeah,
that was great.
I appreciate that. Yeah, I'm concerned about the model railroad industry as a railroad fan. But
so if I'm a person a company that sells model railroads to people who buy them here in the United States, and this is manufactured in China, I would be placing my orders today for Christmas.
That's correct. And so I would be placing them. These are low run batches. So like unlike say a Mattel toy or a Hasbro you're producing, 1 million or 10 million or 100 million of these products of the same SKU and design. When you get into this sort of niche manufacturing, a lot of toys are sort of handmade, hand built, low runs. It's hard to produce that in the United States because of the amount of work it takes. It's far more expensive. And so you end up ordering these products, takes 6 months. And so what's happening right now is companies just aren't ordering. They're simply on hold. And so the longer that we have these tariffs, and the reason they're not ordering is because they don't have the margins in it. And I think this is a big thing that consumers need to get their head around is the vast majority of products, you look at Shein and Temu and they're like, oh, this thing has 500% markup. And that is absolutely the case with certain types of products. But when you get into certain other SKUs, the majority of products are lower margin. They may have 30 or 40% gross margins in it. They simply cannot afford 145% markup. And so putting that on hold entirely means that our new order is going into China. And so what's happening is if we go a couple of months in this process of no orders, if we look out and see the fact that we don't have resolution, then we could be looking at Christmas with a lot of empty shelves. A lot of empty shelves. And I think it's not the big box retailers that are going to experience this. It's not the big brands that necessarily are the ones that are going to experience this. That's going to happen. It is the small boutique businesses. The vast majority of small businesses in America are not and cannot take the financial risks, nor have the capital to be able to import products to the degree that they did before, because they simply don't have the money. They can't afford the tariff, and they can't take the financial risk of paying the tariff and not being able to mark up the product to consumers. So it's just better for them to do nothing.
So let's talk timeline. So right now, I've read some of your quite a number of your articles. You're basically saying we should start to feel some impact, like this month, mid-month, end of month. And when you wrote impact, like what areas do you think are going to be impacted?
Well, anybody who works around the port are going to be the first to feel it. I mean, obviously, right? Like if there's a substantial drop off in containers flowing from China, if I work around the port of LA or Port of Long Beach, I'm just not going to have as much work. There's not as much volume. So anybody in Southern California that works in logistics, and by the way, there's over 500,000 people who work in logistics alone in Southern California. There's 9 million people that nationwide. logistics is the number 2 employer in Southern California, which is kind of insane.
Really? What's the number 1 employer?
I actually don't know this fact, but I happen to read that logistics was number 2.
Okay.
So I don't know. It's maybe, a lot of times.
So 500,000 people are employed in California, Southern California.
In logistics, yeah.
In logistics.
It's the second largest employer as an industry in the entire.
Okay. So those people, there'll be layoffs.
There will be, substantial layoffs because you don't have the volume. So what happens is it shows up at the ports first. Then it ends up impacting the truck drivers that pick up freight at the ports. We call them dray drivers. Then it would go into the warehouses because, again, as you have diminishing volume, you don't have as much work. You're not going to need as many employees. You don't want to pay these people. And so you start to see it sort of revive, sort of go from the ports to the truckers to the warehouses and distribution centers, and then the railroads, and then the over-the-road truckers, which take stuff from California, from these warehouses across the country to wherever they're being consumed, along with the railroads. And so what ends up happening is this sort of looks like a virus of sorts. Like you start off in one sort of part of it, and as it veins out from Southern California, then what ends up happening is the rest of the country will start to feel that pain. And so we're estimating that based on what we're seeing, trucking imports are approximately 20% of the trucking volume across the country. With the drops that we're currently seeing, we think that the amount of volume across the entire trucking marketplace is probably around 5% drop nationwide of trucking demand, which may not seem like a lot on the surface, but I think it is far more substantial because it's an industry that operates on very low single digits. It's already an industry that's been in trouble through what we've called the Great Freight Recession, which is a 3-year downturn.
Could we just backtrack for a second? You mentioned this is not my area of expertise. There's been a great freight recession now for years. Why has there been
too much cash? Recession? I mean, too much capacity.
And that capacity was created when and why?
Because of all the government stimulus that happened during COVID. So what happened were a couple of things. One is the government was giving away a lot of free money, and everyone was hearing about the fact that trucking, was a driver shortage and supply chains were crazy. So everybody went out. It seemed like everybody went out and bought a truck and said, "Oh, I could run a trucking company. I could be a trucking entrepreneur, making all this money." And they're hearing about people making $300,000 to $400,000 driving a truck, or a guy who I knew that was in insurance, had never spent a day in his life in trucking, went out and bought 100 trucks, got financing because the banks are able to write it. And of course, now he's bankrupt. And so what happened is there's no barriers to entry. So we saw a growth of 28% in the total amount of capacity during COVID. And so the whole nationwide, we saw hundreds of thousands of new businesses being created in the trucking industry. And the problem is once you add that capacity, so the capacity will try to match the real-time supply and demand. So the supply and demand are always trying to match each other. And so demand will pull on supply. And as demand shot up, supply tried to correct. Well, it ended up overcorrecting. And then demand dropped off because there was no COVID excess. Stimulus went away. Consumers started to spend money on airlines and experiences and not on goods. And you ended up having overhang. You have a massive overhang because you have this is the same thing that happens in the oil business is when oil prices are high, every wildcatter in the country goes out and buys an oil rig. And you end up with too much capacity. It's a boom and bust. And this is what happened in trucking. And the industry was finally getting back into balance. Like things were headed in a good direction and the amount of capacity was starting to match demand. And we were starting to kind of come out of this freight recession. And then about Valentine's Day of this year is when everything kind of fell apart. And it's when and I can see it in the data. This is about the time where we started to see the tariff conversation on Mexico and Canada, the fentanyl tariffs. And the concept, again, going back to what we said earlier, is the Trump administration argued that the cartels in Mexico were working with Chinese-based fentanyl manufacturing and bringing over product from fentanyl from China through Mexico to the United States, and that's why he had to stop it. And he argued Canada, which I think is an entirely different conversation, which I think was very just personal between Donald Trump and Justin Trudeau, but I'll leave that aside. We'll let the political commentators think about that. But effectively, what was happening is that first set of tariffs, and I think so many people were surprised by his vitriol towards Canada, and particularly if you work in supply chain, you're like, we didn't sign up for this. Like, even if you voted for Donald Trump, you're like, wait a second. We need Canada and we need Mexico. If we're going to rebuild manufacturing, we need it here. And so a lot of supply chains executives were caught off guard. A lot of businesses were caught off guard.
Some people started to weaken their orders.
Yeah. And so I think we saw a little bit of pause on investment because we knew that tariffs were coming, and it was like, hey, tariffs are on, tariffs are off. Like these products are exempt, these products aren't. And it was mass chaos for the first couple of months.
So we could dig down nitty gritty. Like, okay, so I understand the ports get impacted first, then the truckers, but the U.S. only exports we import a lot of stuff. We don't export that much stuff to China. But overall, the U.S. only exports exports only account for 11% of our GDP.
That's right.
Yep. But we do import a lot of stuff. So if I'm looking at all the industries in the United States, and a lot of them import stuff, and some of them import a lot of stuff from China, from your vantage point, what industries are most impacted by this? And let's just stick with China right now. Let's assume, I mean, God willing, there'll be a deal between the U.S. and China. But let's argue, for the sake of argument, that it ain't happening this year. That the China, everybody wants to say, pounds their chest and say, I'm Mr. Strong. I'm not going to lose face. So, ultimate resolution, let's hope. But let's argue, for the sake of argument, nothing happens in 2025. What industries in the United States are most impacted by this?
Yeah, I mean, look, let's first talk about exports, because I think you started there. I think farmers are significantly stressed right now because farming, I mean, the primary imports that China gets from the United States are farm and agriculture goods. It's soybeans, it's pork.
Just so everybody knows, we only export about 145 billion to China, and they export to us about 450 billion to us. So and the biggest export that the United States has to China is agriculture.
Yep. And so that's the primary things. Obviously, you get into things like aerospace. We saw the Boeing. I mean, aerospace, the aviation sector is actually a primary export. In fact, when Boeing has a problem, it shows up. It's big enough to show up in the GDP data and big enough to show up in the export data, because Boeing is such big ticket and such a large percent of our industrial exports are related to aircraft. So we export a lot of aircraft around the world. China has cut off trade with Boeing. It's interesting because China has not just cut off trade with the United, or has put pressure on the U.S., but they actually, and the U.S. is now doing this as well, is they're actually picking on very specific companies like Boeing and saying we're not. I mean, if you're saying we're not taking commercial aircraft from the United States, you might as well just say we're not taking planes for Boeing, which is what happened. Right. Because outside of Boeing.
But that basically means they're not taking commercial aircraft.
That's right.
Because Airbus cannot all of a sudden say, okay, we'll build 20 more planes. It doesn't work that way.
Well, Airbus I mean, this is from a market. I mean, if you know the whole story about Boeing, Airbus, and say Embraer, which is the Brazilian manufacturer, is that, Airbus will pick up orders, incremental orders. Now, they may be 3 years out, but a lot of the airplanes that have been canceled were orders. There was a backlog. This stuff takes, maybe 1,
years.
2, 3, 4. You remember these supply chain backlogs.
So Boeing lost some of its backlog.
Yeah. So a lot of the orders will go to Airbus, or they may decide, hey, let's wait and see if we can get a deal, and let's use that as leverage over, Donald Trump, the Chinese being. And so the stuff that I would be particularly concerned about. Now, the reality is Boeing's got its own set of issues. There's enough demand for aircraft where it's painful, but I don't think it's the end of the world, because this is a company that gets an enormous amount of government support, both direct and indirect. So I'm not overly, if I'm looking at things that are impacted.
You're not so worried about Boeing.
What's that?
You're not so worried about Boeing.
It's too big to fail. It's too important to America's Defense Department to fail.
Okay, so farmers obviously get impacted. Boeing lost some orders. Anybody else on the export front before we turn to imports?
Big industrial machinery, particularly in agriculture machinery, a company like John Deere, that is big ag is also potentially at risk. Companies that are in the metals and mining and energy sector that have technology are at risk. Anything that's highly specialized around software and technology that's built into some of this big machinery is also at risk. So those are the things that are exports. But the story is not about exports when it comes.
No, the story is about imports. So let's turn to that. Let's assume again, there's a month or two from now, there is bupkis coming from China into the United States.
I think
more or less. What happens? Who gets hurt?
Yeah, so I think the stuff that China produces. So let's get what doesn't get hurt, because I just want to be very clear. Everyone immediately thinks about food. They're like, "Oh my God, we're going to run out of food!" Because they assume incorrectly that China produces a lot of our food. That's absolutely
not true.
95, probably 98% of the food we consume in the United States is actually made here. We're a net food exporter. So don't worry about food. So outside of
everybody's going to be able to eat.
Everyone's going to eat. Your gas, you're going to be able to get gas at the gas pump. Don't worry about that. The stuff that you should be worried about are high volume manufactured goods. These are things like disposable batteries. They're things like it's also situational, like toys. We talked about that. Anything in the toy sector is concerning. A lot of apparel certainly is, like athletic shoes is a concern, but a lot of apparel has actually moved out of China into other parts of Asia. So it's interesting because China doesn't make the kind of clothing that they used to make. A lot of that, they said, we don't want these products produced here. They're too cheap. Let's get them. Let's take our businesses and take them to other parts of Asia. And so what you're looking at is, we've talked about electronics in the past, but the electronic sector, the Trump administration sort of gave way to that and said that they are no longer subject to these tariffs. A lot of industrial machinery, things like appliances are concerning. Things that go into houses.
Are the entire appliances made in China, or just parts?
Not all appliances. Typically, the lower end appliances are made in China.
Like what?
I mean, it could be your air conditioner, could be your refrigerator. I mean, different brands, right? Some of them, we have brands that are made in the United States. Like there are appliance brands that are still made in Michigan. There's an appliance factory not too far from Chattanooga in North Georgia. So, but you go to a number of appliances, so washing machines, vacuums, like air conditioning systems, and probably as much worrisome as the parts that go into these things. So let me give you a scenario. Let's say that
this is like an example of, like, for want of a screw, my machine's not going to work.
Something like that. But I have an air conditioning unit at my house, and I just had a compressor die. So, and my tech came out and he had to order a new compressor. Great. Was able to get his hands on a compressor, and 2 days later, my AC is working.
Thank God.
It's April in Chattanooga. It's mild weather. No problem, right? The issue is, if that was late July in Tennessee, and because these products are sourced from China, the chances are that the importers that are importing these components, the companies that make these machines, are not bringing over their supplies of parts. And so
you wouldn't be able to get a compressor.
In late July, I may be sitting at my house sweating for 3, 4, 5 weeks.
Right.
Because I can't get my hands on air conditioning. So I think what you'll see is in mid-June, you'll have incremental shortages that probably will not create a lot of alarm. In July is when you'll start to hear more and more of this. And by the time we get to back to school is probably the first moment where I think, and I always use the suburban mom as the supply chain crisis actor. So the suburban mom is the one that's going to realize we have a problem when she goes to take her kids to go get stuff for back to school. So the backpack selection, whatever
is less. The notebook selection is less. The paper selection is less.
Exactly. The pencils, the pens,
whatever, everything.
Trapper Keeper. I don't even know if they're around anymore.
So let me ask you a question, because you mentioned something in a prior interview, and I'm just going to quote it because I found it. So the economist from Apollo put out a piece basically predicting a recession.
Yep.
And the way he predicted it was, He says April 2nd was Liberation Day. Excuse me, I'm actually reading from the presentation. And then he says it's 20 to 40 days container ship transit time. So early May, mid-May, the container ships to U.S. ports, he says, comes to a stop. You're not saying it comes to a stop. It could be, it's down 35, 40%.
I mean,
and then
in my world, that is as well as
that's huge. But yeah. The guy likes to be a little
provocative.
Come to a stop means down 100%. Yeah. It's bad. 35, 40% is bad enough. Yep. So then it takes 1 to 10 days for truck rail transit times to cities. So he says mid-May, late May, trucking demand comes to a halt. Well, it's not coming to a halt because, as you said, this is only 5% of trucking, but it certainly hurts trucking margins. And then empty shelves and companies respond to lower sales. Well, the shelves aren't empty, but there's less stuff.
There's less selection and certainly variety.
Right. And then he said there'll be layoffs in trucking and the retail industry in late May, early June. He thinks there's a recession by the summer of 2025. You seem to think the real impact's going to take place in August, September.
I think let's talk about two different things, because I think there's the supply chain shortage problem and there's the economic problem, and they're actually two different problems. So the economic problem will be felt much earlier. In fact, you could argue, based on the GDP print we saw today, that it already is being felt. And
it's arguable because there was a 40% increase in imports.
Fair.
That's a negative on the GDP calculation.
But you also look at the survey data with the state.
Yeah, the survey data is not
and all
great.
this stuff. But regardless,
but the survey data is also emotional.
Well, but we are seeing and have seen a pretty sharp decline in trucking freight data. Like, we get real-time data of trucking demand. This is what we do.
So what is the trucking data showing?
So if you take and look at it from where we were at in mid-February to where we're at now, we're down about 12%. And so
that's a lot.
It is a lot. I mean, we're looking at
that's actual trucking shipments.
Actual truckload shipments are down already by 12%. And so we are trending, like, I use LA as the barometer, because in the trucking business, whatever happens in LA does not stay in LA. What happens in LA
comes to the rest of the country.
Is very ominous for the rest of the country in the coming weeks and months. And so if you look at Los Angeles trucking volumes, we're already, and this is prior to the import collapse that we're about to see, in the process of seeing, we're down 28% year over year. And
I'm sorry, what's down 28% year over year?
Trucking volumes out of Southern California.
Out of Southern California.
To the United States, so the rest of the country. Mm-hmm. And it's an important city because it tells us what's about to happen throughout the whole country. We were already seeing a significant slowdown in trucking demand happen, a wave across the country. That's the first wave, we'll call it. The bigger wave, the tsunami, is actually coming, and this is the import collapse. And that will be the second wave. That will be far more impactful, because the trucking business is still, even though we've seen a sharp drop, it still had record imports coming into the country, and they're moving those things around. But what we're about to see is absolute concerning, because once the slowdown in those imports hit the Southern California ports and eventually will hit the East Coast ports, then you're going to get things going to get really soft really quickly. And so when that happens,
so explain to me the translation mechanism. So imports come way down. Mm-hmm. How's that going to impact the economy?
Well, I can only talk about freight. So what I do is freight.
So there's basically what you're saying is going to be a lot less stuff in stores.
A lot less stuff. So what happens at the trucking companies, like, trucking is it has one of the worst return on assets and return on investments of any business, because for every demand input, you need a human input. So the problem is, like, if I lose a truckload, then that is basically a person's job for that day. And so when you see if we see a 6% contraction in freight, you're likely to see a 6% equivalent contraction in employment.
Right.
And so the whole thing is, there are 9 million people who work in logistics in the United States. If you sort of just take that same 6% number, maybe you're not getting full 6% contraction, maybe you're getting 5% contraction in employment. You're looking at the potential of 450,000 to 500,000 jobs in trucking alone. UPS, we actually saw this UPS
The UPS was talking they're going to cut
laid off
20,000
20,000
jobs.
people. One of the
Yeah.
largest layoffs. I don't remember UPS ever laying off anybody, but I again, this stuff is so fast and furious, working 20-hour days. So I haven't had a chance to go research that fact, but
Right.
the reality is what's going to happen is there's going to be this massive wave of slowdown throughout the country. And that will be in the sort of first set of the market. So what else gets impacted? Truck stop volume, diesel consumption gets impacted. Anybody that works in the logistics sector that supports it gets impacted. Truck OEMs, the people that build the heavy-duty trucks, they get impacted. The banks that finance trucking get impacted. And so you start to see this start to reverberate through the economy.
It's like a virus, like you said.
Exactly what it's like.
It just starts to spread.
That's the trucking.
So you're of the view that unless a deal is struck fairly soon, and I would put the probability of that at almost nothing at this point. Yep. That's my personal opinion.
I agree. I actually agree with you. And then we
go into a very big slowdown at least.
Absolutely. And I actually think we're there. And I think when you talk to, it's so weird to me watching financial markets, because I look at the financial markets and then I look at what we're seeing on the ground.
And what are you seeing on the ground?
There's a massive disconnect between what the Main Street goods economy is actually, what we are seeing in the goods economy with our data right now and what's happening on Wall Street.
So right now you are seeing in your data a massive slowdown in logistics businesses.
Absolutely.
Hard
and if you
stop.
Don't, and let's say that someone's listening to this podcast and like, that guy's nuts. I don't believe half of what he says. Go look at every public trucking company, not Craig Fuller. Go listen to the transcripts of all conference calls. And they're not all positive. Saying the same thing, right?
They're not positive. But you know what's interesting? I was looking at J.B. Hunt, for example. I'm curious what you think about this. Let me find my notes. So J.B. Hunt's stock price is down. It was a high of 190. J.B. Hunt, for everybody who doesn't know, is a big trucking company in the United States.
Yeah, mostly intermodal. Half their business is intermodal.
Right, half intermodal, half trucking. So the stock was 198 in November. And when I looked at it yesterday, it was 130.
Yep.
So, that makes sense to me. That's a decline of 34%. And then a sell-side firm, that doesn't matter because it's basically consensus. So they wrote a note after J.B. Hunt reported, and they lowered their 2025 EPS estimate to $5.60 from $5.85. And then I looked, but J.B. Hunt made $5.56 in 2024.
Yeah.
And now maybe, it was, like you said, there's a logistics recession in the country. So 2024 wasn't a great year for J.B. Hunt, but it didn't. And I'd be the first to admit, I know nothing, but that doesn't pass the smell test to me. If this continues, how in the world is a company? And I'm not picking on J.B. Hunt. I'm just using this as an example. I can't imagine how J.B. Hunt could have a flat year versus last year if this keeps going on.
Well, I think there's a couple of things to sort of keep in mind. J.B. Hunt is definitely the most insulated from the broader trucking slowdown of the trucking companies because of it's such a strong intermodal player. J.B. Hunt's concentration tends to be with very large companies that move a lot of volume, and those companies, and I'm talking about Target, Walmart, Amazon, Lowe's, Home Depot, those companies will gain market share over every other retailer because those companies have highly sophisticated supply chains that will do much better than the average company because they global source. They will already bring in imports.
Fair.
And so
okay, now I understand. So J.B. Hunt will do better than other trucking companies.
But let me tell you why I also think the intermodal element is also the low-cost solution. And so when you're in intermodal, it means
define intermodal in this case.
Intermodal is trains. So J.B. Hunt, half their business, they are the bellwether of the intermodal business. They're probably 40% of the entire railroad intermodal business is J.B. Hunt. They just own that whole business. It's a whole structural reasons for why they do, which I won't bore anybody with. But the reality is they are the leader when it comes to providing. So they tend to do better than most, even in soft times, because of their intermodal business. And when you have a recession, It's sort of like the dollar stores, or it's sort of like Walmart. It does better than relative to every other player. But what you probably aren't realizing is that JB Hunt is also the first company to go when there's earnings season. So they do their earnings calls 2 weeks after the end of the quarter. And when they did it, and I don't remember the exact date, I think it was the 16th or 17th of the month.
Seems like an eternity ago.
It was a week into the Liberation Day tariffs. And so what I think probably is reflected in JB Hunt was when they gave their commentary, there was a large level of belief, and I know this because I live and breathe it quite closely, is there was a large belief at that point in time is that we would get a resolution really quickly. And I even think when JB Hunt had its conference call, I have to go back and look at the dates, but I don't even think we're at 145% at that moment in time.
No, I don't think we were.
And so if you're an analyst, you've already downgraded the stock. You're probably not going to hit them again until you still get more. There's no point in just downgrade it again. You're going to wait.
So worst case scenarios are not in these numbers.
I do not think
is your guess. I'm not holding you to this. I'm just saying. I'm not
picking on JB Hunt. I think if you're going to own a transport, JB Hunt's your best play, and you may be able to get this one pretty cheap. And so the issue you get with, and so the only reason I bring up the commentary is what is more interesting is to hear the companies and what their CEOs are saying or CFOs are saying about where we've been in the first quarter and what's likely to happen. And I think if you go look at the earnings calls that got later and later in the month, the situations of those companies got worse and worse.
Okay, so the commentary deteriorated by the day.
Correct. It wasn't as if what happened in the 3 months from January 1st to March 31st changed, but the sentiment of what was coming and the outlook going forward did change quite quickly. I mean, we're in the fog of war, and I can tell you in what I do, and I'd like to think I'm as knowledgeable about this topic as most, is it's happening so fast and furious that it's hard for me to keep up, because you get the situation where the White House will say something and they'll put out an executive order. You read the executive orders and you're like, I think that's what that means. And then you see another executive order that contradicts that executive order. And then
we're trading headlines. That's clear. And I can't even imagine, if I'm running a trucking business or a logistics business, like how I operate from day to day is unimaginable to me at this point.
I mean, the good news about our industry, the freight industry, is we are a really rugged set of people. It takes a lot of grit. This is the most cyclical, fragmented industry on the world and probably on the planet. It is an incredibly violent business, a single-digit operating margins. It is incredibly competitive. And so if you can survive years in trucking, you got some grit. So this is just one more thing our industry has to deal with. And I think that's why companies like JB Hunt, companies like Werner, companies like Saia and XPO and all these trucking companies that have been around for a long time, their executives have seen it. We've seen the worst of it. And they'll be fine. The problem is this seems like it's just massive chaos. I think our industry has a lot of grit. They will get through it. It's not going to be fun, but there will be layoffs because this is what we do as an industry. We're used to hiring when there's a binge and we're used to laying off when there's not. It's just trucking.
On that note, Craig, thank you very much. That was very informative. Like I said, the Reacher slogan, in any investigation, the details matter. You know the details, and we really appreciate it. Thank you very much.
Thanks for having me.
Thank you so much for tuning in. For video episodes of this podcast, head over to our YouTube channel. If you're listening on a podcast platform, make sure to follow the show so you never miss a new episode. And if you got something out of today's conversation, we'd love for you to leave us a 5-star review. It helps us reach more listeners just like you. For links to our website, social media, and to sign up for our newsletter, please check out the show notes of today's episode. On that note, I'm Steve Eisman. I'll see you on our next episode. This podcast is produced by Collier Landry for Don't Touch My Radio and Steve Cohn for Next Horizon Media. Copyright Steve Eisman, Farseer LLC.